When you think about that, what type of asset do you think could be kind of the breaking of the dam in demand? Like what type of asset would that take?
A little selfishly and self-promotional, but I obviously think that the Republic Note token, which we launched the public sale a few days ago, and glad to share that the soft capital we put was oversubscribed within just a couple of days. But we have a very large community, and our token, I should describe it a little bit, is a profit-sharing token. That is, when a company on Republic sees an exit, we realize some proceeds and we pay that proceeds out to the token holders proportional to the token that they have. So if someone buys a Republic token and Robinhood or SpaceX goes public in 2 years, there's going to be a very small amount, but an amount being paid out to the token holders. That is relatable, meaning people can look at it and say, here's a regulated business with clear revenue, with over $150 million have been invested, and they have upside in these deals. And we have this community, which is 700,000 and growing. So we do think that our user base alone is larger than many exchanges. And so we have the ability to in and by itself, feel that liquidity and demand, but we are just, basically the first of many to come. Our goal is to identify major movies, sport leagues, studios, real estate portfolio, help them tokenize and make it available to the masses. But yes, I mean, the use case for tokenization, I think are just countless. And the concern is once the floodgate has been opened and people see the value in it, how can the system accommodate, let's say all at once, 20 different very large enterprises wanting to tokenize, but that's a good problem to have.
For sure. And maybe explain a little bit more about the Republic Note token, because I saw a couple of announcements online, but my understanding is an investor can come in, they buy the token, all of that money gets pooled together, it gets invested into deals that go through the Republic platform. And then as there's profits, it gets distributed back on a pro rata basis to investors, or am I misunderstanding that?
Yes, no. There's no reinvestment in this one sense. Think of the easiest way of looking at it is this. If I may use an analogy, back in 1996, if Amazon were to say that, hey, we're gonna issue pre-minted fixed 800 million token, and then we're gonna put 25% of our revenue from there on. Whenever 25% revenue is generated, they're gonna make a distribution out to these tokens on an evergreen basis. At the time, probably was a modest distribution, but obviously fast forward 20 years, each of those tokens would be, I don't even know how many hundreds of thousands of dollars in value. The same concept here, which is we pre-mint a fixed pool of token, and then on a perpetual basis, we will make distribution of profit back to the token holders. What are those profits? Well, we have an upside. Every company that raises on Republic, we have an upside potential. Whenever a company sees an exit, that upside potential is realized in cash. That cash is paid back through a stream, an issuer, and going back to the token holders. So another way of looking at it is that when we started out with this project, and I think we were Binance's first portfolio company, we had done only about 15 raises, and we've raised less than $6 million. And even at the time, Binance was like, there's a potential for this. With the pool of future profit and asset over a year and a half, 2 years, now it's over 150 million in total amount raised. And the pool of asset is probably worth at least 20 times what it was in 2018. So if we continue for 2 more years, it's just increasingly amplifying on an evergreen basis.
Yeah, that's awesome. And what's really interesting about this is the profit share is basically the profit of all of the successful companies that go through the Republic platform, right? Because if they're unsuccessful, there will be no profits. But when they are successful, it's a way to kind of almost index your exposure to a bunch of different companies, it seems like.
Correct. So the unusual attribute of that, and you being one of the most prolific and known venture capitalists in the space, as well as generally speaking, we all know that if you just invest, even if you, Palm, were to just invest in one or two or three deals and no more, I mean, there's a high risk of you seeing very little of that money back, right? So the name of the game is obviously a number game, even among the very best venture capitalists. So what's unusual about the Republic Note token is that it gives note holders indirect exposure on an evergreen basis, meaning at one point, say 10 years down the road, Republic has done 15,000 deals through crowd capital, that every note holder, as long as you hold a note, when a company out of that pool exit, you're going to see a payout, which lends itself to a very unusual token economics issue. That is, people will be reluctant to sell because the moment that if I hold a note token and I will sell it to you, Palm, and all of a sudden Robinhood sees an exit, the payout will be to the new note holder, not me. So out of that psychology of wanting to hold on for long-term return rather than pump and dump, I do think that it's going to introduce an interesting, but probably a positive dynamics to token economics compared to what we have seen in the past couple of years.
Yeah, it's super interesting. And I guess, how does this impact the traditional markets, right? So we see like a Coinbase, for example, that's been talking about, or at least rumored to be talking about potentially going public. I know that Brian Armstrong previously had said that like the most on-brand thing would be to digitize or tokenize the equity of the business. It sounds like maybe now they're exploring the traditional side. At some point, it feels like those two markets, like they meet, right? And either they merge together and play nicely, or one ends up winning and the other ends up losing. And so just kind of, how do you think about digital securities versus traditional market over like a very long period of time?
I'm obviously gonna guess, make a guess here on the decision making process at Coinbase. But I think at one point, the management team at Coinbase made the decision that, hey, we're so large now in an institution that it's easier to go through the IPO, the traditional going public process, than dealing with digitizing and digitized tokenized securities, given that the traditional process, there's a clear roadmap, there's less of a risk, there's less of a gray area. It comes with a lot of hurdle, but it's exactly what, they are what they are. People have done it before. And yes, it is a way to provide, public access. That said, there are still limitations to the traditional model in that once and if Coinbase is listed on NASDAQ, it's not easy at all for a Chinese resident, an Ecuadorian resident, Peruvian, Vietnamese to participate. Those people cannot easily buy Tesla today, and they will not be easily have access to Coinbase in the future. I think down the road, I think it will take probably at least 5 years for the traditional public market to be digitized and modified by what we will see in the STO world. But over the next year or two, the change in STOs and digital securities for early stage companies and projects, I think will pose a serious, or at least raise a serious conversations for the NASDAQ of the world, because they know that in 5 years out, they won't have candidates to go IPO, given that people would already opted for digital offerings much sooner.
And so it sounds like it's fair to say that people can go from traditional non-digitized equity and digitize at any point, right, in the kind of the life cycle of the business. But it's much harder if you start out with digitized equity and kind of this token structure to go back to the traditional world, right? So at some point, once you cross over, it's hard to go back and say, if I raised money early on through a digital token structure as equity, to then go get listed on the NASDAQ or the NYSE would be pretty difficult.
Well, it is rather than difficult, I would say it's an unknown. And within that kind of highly regulated world, any unknown poses a risk. So I would say that it's rather than it being difficult, as long as in your structuring of your digital offering, your STO early on as a private company, build in there a framework that is good for investor, good for token holders, but gives you the ability that if you so choose, it becomes so crucial for the company to go public traditionally, that you have a way to give return back to note holders and basically be able to claw back those tokens in a way that token holders are happy with, and random shares in return. So there's still ways for you to go to reverse and undo things. At least we do see a path for that. But that is a big unknown, and a question in my mind is whether or not the IPO model will continue to exist 5 years out, 2025 and above, and beyond. I don't know that you will see the kind of like Uber and Coinbase IPO that we are seeing now.
And we already see in the traditional world, there's definitely some movement or change, right? So we've seen the Spotify's and the Slacks do direct listings. We've seen the Virgin Galactics go through these kind of SPAC acquisitions. And so there's definitely some pressure there, or some change. It feels like digital securities is kind of further out than just a 1 or 2 year thing. But to your point, if it can solve some of these problems, there's a lot of companies that say, why wouldn't I do that if it's just a better path?
And not only that, truly the SPAC and the IPO process is only for the Coinbase of the world. And even then, compared to the 90s, the number of companies, the number of public companies out there in the US, I think something like 50% less than it was like 30 years ago. So it has been a trend that's like less and less, companies choose to go public. The notion of digital securities and STOs is such that it's usable, applicable to even seed stage companies and projects. So I do think that currently in the near term, the two models serve two different demographics. Coinbase is probably the only company that I imagine that there was ever a board conversation of, should we tokenize our equities and make it available that way, or should we go public? And they seemingly chose to go public. But for pretty much everyone else, that's not a dilemma that they have to deal with, I don't think.